School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview, Unit-2 Preparation of Books of Accounting, Part-2.
Journal. Journal is a historical record of business transactions or events. The word journal comes from the French word jour, meaning day. It is the book of original or prime entry. Journal is a primary book for recording the day-to-day transactions in a chronological order, that is, the order in which they occur. The journal is a form of diary for business transactions. This is called the book of first entry since every transaction is recorded firstly in the journal. Journal entry. Journal entry means recording the business transactions in the journal. For each transaction, a separate entry is recorded. Before recording, the transaction is analyzed to determine which account is to be debited and which account is to be credited. Now, let's make you understand the performer of journal. Column 1 is for date. The date of the transaction on which it takes place is written in this column. Column 2 is for particulars. In this column, the name of the accounts to the debited is written first, then the names of the accounts to be credited, and lastly, the narration, that is, a brief explanation of transaction are entered. Column 3 is for LF or ledger folio. Ledger folio means page of the ledger. In this column, we enter the page numbers on which the various accounts appear in the ledger. Column 4 is for debit amount. In this column, the amount to be debited against the debit account is written along with the nature of currency. And column 5 is for current account. In this column, the amount to be credited against the credit account is written along with the nature of currency. Advantages of using journal. Journal is used because of certain advantages. Number 1. A journal contains a permanent record of all the business transactions. Number 2. The journal provides a complete chronological history, that is, in order of the time of occurrence of all business transactions, and the task of later tracing of some transactions is also facilitated. Number 3. Complete information relating to one single business transaction is available in one place with all its aspects. Number 4. The transaction is provided with an explanation technically called a narration. Number 5. Use of the journal reduces the possibility of an error when transactions are first recorded in the book. Number 6. The journal establishes the quality of debits and credits for a transaction and reconciles any problems. If a business purchases a bicycle, it is necessary to decide whether the bicycle represents ordinary goods or machinery. Further, any amount paid is debited to bicycle account and credited to cash account. Number 7. The use of journals avoids omission or duplication of transactions or pass of transaction. Without the journal, the accountant would be forced to go to the individual account to enter debits and credits. Therefore, it is possible for accountant to miss part of a transaction, duplicate all or part of a transaction, or incorrectly record debits and credits. Even with the journal, it is still possible to omit transactions and make other errors. However, the journal reduces these problems. And number 8, Once a transaction is recorded in the journal, it is not necessary to post it immediately in the ledger accounts. In this way, the journal allows the delayed posting. In connection with the journal, there are certain points that one needs to remember. Number 1, for each transaction, the exact accounts should be debited and credited. For that, the two accounts involved must be identified to pass a proper journal entry. Number 2, sometimes the journal entry may have more than one debit or more than one credit. This type of journal entry is called compound journal entry. Regardless of how many debits or credits are contained in a compound journal entry, all the debits are entered before any credits are entered. The aggregate amount of debits should be equal to the aggregate amount of credits. And number 3, for a business, journal entries generally extend to several pages. Therefore, the total are cast at the end of each page against the debit and credit columns. The following words and certain words are written in the particular column, which indicates carried forward of the amount on the next page, that is, total carried forward. The debits and credits total of the page are then written on the next page in the amount columns. And opposite to that, on the left, certain words are written in the particular column to indicate brought forward, that is, of the amount of the previous page, which is total brought forward. This process is repeated on every page, and on the last page, grand total is cast. Journalizing. Journalizing is the process of recording journal entries in the journal. It is a systematic act of entering the transaction in a day book in order of their occurrence, that is, date-wise or event-wise. After analyzing the business transactions, certain steps in journalizing are followed. They are: number 1, find out what accounts are involved in business transaction. Number 2, ascertain what is the nature of accounts involved. Number 3, ascertain the golden rule of debit and credit is applicable for each of the accounts involved. Number 4, find out what account is to be debited and which is to be credited. Number 5, record the date of transaction in the date column. Number 6, write the name of the account to be debited very near to the left hand side in the particulars column along with the word DR, that is debit, on the same line against the name of the account in the particulars column, and the amount to be debited in the debit amount column against the name of the account. Number 7, record the name of the account to be credited in the next line preceded by the word to at a few spaces towards right in the particulars column, and the amount to be credited in the credit amount column in front of the name of the account. Number 8, record narration, that is a brief explanation of the transaction within brackets in the following line in particulars column. And number 9, a thin line is drawn all through the particulars column to separate one journal entry from the other, and it shows that the entry of a transaction has been completed. Goods account. Generally, the term goods include every type of property such as land, building, machinery, furniture, cloth, etc. However, in accountancy, its meaning is restricted to only those articles which are purchased by a businessman with an intention to sell. For example, if a businessman purchased typewriter, it will be goods for him if he deals in typewriter. But if he deals in other business, say clothes, then typewriter will be an asset for him and clothes will be goods. Subdivision of goods accounts. The goods account is not opened in accounting books, and it is to be noted that goods includes purchases, sales, sales returns, purchases return of goods. However, purchase account, sales return account and purchase return account are opened in the books of account. Purchases account. This is opened for goods purchased on cash or credit. Sales account. This account is opened for the goods sold on cash or credit. Purchase returns account or return outward account. This account is opened for the goods returned to suppliers. Sales return account or return inward account. This account is opened for the goods returned by customers. Opening entry. In case of going concern at the beginning of the new accounting year, new books of accounts are opened and the balances relating to personal and real accounts appearing in the books at the close of the previous year are brought forward in new books. The entry for this purpose in the books is called opening entry. The opening entry is passed by debiting all assets and crediting all liabilities, including capital. If the amount of capital is not given, then this can be found out with the help of the accounting equation, which is assets equal to liabilities plus capital, or capital equals to assets minus liabilities. Important considerations for recording the business transactions. Number 1. Trade discount. Trade discount is usually allowed on the list price of the goods. It may be allowed by producer to wholesaler and by wholesaler to retailer for purchase of goods in large quantity. It is not recorded in the books of account and entry is made only with the net amount paid or received. For example, purchased goods of list price Rs 8,000 at 15% trade discount from X. In this case, the entry will be passed purchase account debit Rs 6,800 to X Rs 6,800. Now, the narration will be being goods purchased at 15% trade discount less list price. Number 2. Amount paid or received in full settlement or cash discount. Cash discount is a concession allowed by seller to buyer to encourage him to make early cash payment. It is a nominal account. The person who allows discount treats it as an expense and debits in his book, and it is called discount allowed. And the person who receives the discount treats it as an income, and it is called discount received, and he credits it in his books of account as discount received account. For example, X owes Rs 6,000 to Y. He pays Rs 5,950 in full settlement against the amount due. In the books of X, the journal entry will be Y debit Rs 6,000 to cash account Rs 5,950 to discount received account Rs 50. And the narration will be being cash paid and discount received. And how are we going to do this entry in the books of Y? Entry will be cash account debit Rs 5,950, discount allowed account debit, repeat, discount allowed account debit Rs 50 to X, that is Rs 6,000, and narration will be being cash received and discount allowed. You will write the narration in brackets. Number 3. Goods distributed as free samples. Now sometimes business distributes goods as free samples for the purpose of advertisement. In this case, advertisement account is debited and purchases account is credited. For example, goods costing Rs 8,000 were distributed as free sample. To record these transactions, entry will be passed as advertisement account debit Rs 8,000 to purchase account rupees 8,000. Number 4. Interest on capital. Interest paid on capital is an expense. Therefore, interest account should be debited. On the other hand, the capital of the business is also increasing, so the capital account should be credited. The entry will be interest on capital account debit to capital account. Number 5. Interest charged on drawings. Now, if the interest is charged on drawings, then it will be an increase in the income of business. So, interest on drawings will be credited. On the other hand, there will be an increase in drawings or decrease in capital, so drawings account will be debited. To record this, the entry will be passed as drawings account debit or capital account debit to interest on drawings account. Number 6. Depreciation charged on fixed assets. Now, depreciation is the gradual permanent decrease in the value of assets due to wear and tear and many other causes. Depreciation is an expense, so the entry will be passed as depreciation account debit to asset account. Number 7. Bad debts. Sometimes the debtor of business fails to pay the amount due from him. Reasons may be many. For example, he may become insolvent or he may die. Such irrecoverable amount is a loss to the business. To record this, entry will be passed as bad debts account debit to debtors account. Number 8. Bad debts recovered. When any amount becomes irrecoverable from any customer or debtor, his account is closed in the books. If in future any amount is recovered from him, then his personal account will not be credited because that does not exist in the books. So, the entry will be passed as cash account debit to bad debts recovered account. Number 9. Purchase and sale of investment. When business has some surplus money, it may invest this amount in shares, debentures, or other types of securities. When these securities are purchased, these are recorded at the purchase price paid. At the time of sale of investments, sale price of an investment is recorded in the books of accounts. The entry is passed to record the purchase of investment as investment account debit to cash account. In the case of sale of these securities, the entry will be cash account debit to investment account. Number 10. Loss of goods by fire, accident or theft. A business may suffer loss of goods on account of fire, theft or accident. It is a business loss and a nominal account. It also reduces the goods at cost price and increases the loss or expenses of the business. The entry will be passed as loss by fire, accident or theft account debit for losses, insurance company account debit for insurance claim admitted to purchase account. Number 11. Income tax paid. Now, income tax paid should be debited to capital account or drawings account and credited to cash account in case of sole proprietorship and partnership firms. The reason behind this is that income tax is a personal expense for the sole trader and partners because it is paid on income of proprietor. So, the entry will be capital account debit, drawing account debit to cash account. Number 12. Bank charges. Bank provides various services to their customers. Bank deducts some charges by debiting the account of customers. It is an expense for the business. To record this transaction, the entry will be passed in the books of businessman or customer as bank charges account debit to bank account. Number 13. Drawings account. It is a personal account of the proprietor. When the businessman withdraws cash or goods from the business For his personal or domestic use, it is called as drawings. Drawings reduce the capital as well as goods or cash balance of the business. The journal entry will be drawings account debit to cash account or to purchases account. Cash if the cash is withdrawn and purchases if the goods are used for domestic use. Number 14. Personal expenses of the proprietor. When the private expenses such as life insurance premium, income tax, home telephone bill, tuition fee of the son of the proprietor, etc. are paid out of the cash or bank account of business, it should be debited to the drawings account of the proprietor. And the journal entry is capital or drawings account debit to cash or bank account. Number 15. Sale of asset or property. When the asset of a business is sold, there may be a profit or loss on its sale. It should be noted carefully that sales account is never credited on the sale of asset. The journal entry is, in case there is a profit on sale of property or assets, the entry will be cash or bank account debit to asset or property account to profit on sale of asset account. And in case of a loss on sale of an asset, the entry will be cash or bank account debit, loss on sale of asset account debit to asset account. Number 16. Amount paid or received on behalf of customer. When the business entity pays the amount on behalf of old reputed customers, such as carriage in anticipation of recovering the same later on, carriage account should not be opened because carriage is not the expense of the seller. It should be debited or charged to customer's personal account. The journal entry is customer or debtor's account debit to cash or bank account. When the business entity receives the amount on behalf of customers from the third party as mutually settled between the third party and the customer, the account of the third party or person making the payment should not be opened in the books of the receiving entity. The journal entry in the books of the entity is cash or bank account debit to customer or debtor's account. Number 17. Amount paid on behalf of creditors. When the creditors or suppliers instruct the business entity to make payment on their behalf, the amount so paid should be debited to creditor's account and liability of the business will decrease accordingly. The journal entry will be suppliers or creditors account debit to cash or bank account. Number 18. The events affecting business but they do not involve any transfer or exchange of money for the time being, they would not be recorded in the financial books. Examples of such events are: Number 1. On 1st of January 2006, placed an order to Geeta and Sons for the supply of goods worth rupees 1 lakh. Number 2. Baban Jot, a BCom graduate, has been appointed sales assistant on a salary of rupees 5,000 per month on January 2006. Number 3. Raman, a proprietor, contacted with Bahia Builders Limited for the renovation of the building at an estimated cost of rupees 5 lakh. Number 4. A shop in Adalt Bazaar, Patiala, contracted to be taken on a rent at rupees 4,000 per month. So such entries or such events will not be recorded in the books of account. Number 19. Paid wages or installation charges for erection of machinery. Now, wages and installation charges are the expenses of nominal nature. But for erection of machinery, no separate account should be opened for such expenses because these expenses are of capital nature and it will be merged or debited to the cost of assets, that is machinery. So the journal entry will be machinery account debit to cash or bank account, and the narration will be being wages or installation charges paid for the erection of machinery. Cost of samples distributed to promote sales is a sales promotion expense and therefore debited to samples account. Alternatively, it can be debited to sales promotion expense account as it reduces the goods purchased for resale. Cost of samples distributed is credited to or subtracted from purchases account. After recording the business transactions in the journal or special purpose subsidiary books, the next step is to transfer the entries to the respective accounts in the ledger. Ledger is a book where all the transactions related to a particular account are collected at one place. Definition: the ledger is the main or principal book of accounts in which all the business transactions would ultimately find their place under various accounts in a duly classified form. Utility of ledger: the importance of ledger is to know the collective effect of all the transactions pertaining to one particular account. By this classification, we are able to know: number 1, it provides complete information about all accounts. Number 2, it provides position of assets and liabilities. And number 3, it facilitates to prepare trial balance. Now, ledger is also called the principal book of accounts. Now, let's talk about the performer for ledger. Each ledger account is divided into two equal parts. Left hand side is called debit side and right hand side is called credit side. Posting in the ledger: this will be dealt separately from journal entries and each subsidiary book. Let's take case 1, posting from journal entries. If an account is debited in the journal entry, the posting in the ledger should be made on the debit side of that particular account. In the particulars column, the name of the other account which has been credited in the journal entry should be written for reference. Now, for the account credited in the journal entry, the posting in the ledger should be made on the credit side of that particular account. In the particulars column, the name of the other account that has been debited in the journal entry is written for reference. Now, some important points are there which you should keep in mind. Number 1, the word to is written before the accounts which appear on the debit side of the ledger. Number 2, the word by is written before the accounts appearing on the credit side of the ledger. And number 3, use of these two words, to and by, is optional. Balancing of ledger accounts. Balancing of an account means to Balancing of an account means to make the total of amounts columns appear. Balancing of an account means to make the total of amounts columns appearing on debit and credit side of an account equal to each other. If the total of amount column on debit side is more than the total of the amount column on credit side, it is said that the account has a debit balance. The balance is termed as credit balance if total of amount column on credit side is more than the total of amount column on debit side. Balancing is done by writing balance carried down and it is written as C/D on the shorter side to make total of debit and credit side equal. The same balance is written as balance brought down and it is written as B/D on the opposite side. Accounts relating to assets, liabilities, revaluation of assets and liabilities and capital are balanced at the end of accounting period. Temporary capital accounts relating to expenses, revenue, gains, and drawings are not balanced. Nominal accounts representing expenses, revenue, and incomes are transferred at the end of the year to trading and profit and loss account. Drawing account is closed by transferring its balance to capital account. Stock account showing stock in the beginning called opening stock and purchases account, although real account by nature, are not balanced. These are transferred to trading account. Now let's summarize the unit. An accounting process is a complete sequence of accounting procedures which are repeated in the same order during each accounting period. Accounting process involves 6 steps or stages, that is, identification of transactions, recording the transaction, classifying, summarizing, analysis and interpretation, and reporting of financial information. In accounting, all the transactions are recorded on the basis of evidence or document, which are mainly of 3 types. Number 1, payment voucher. Number 2, receipt voucher. And number 3, transfer voucher. Recording the transaction is the first step in the process of accounting, which is performed in the book called journal. Journal is a primary book for recording the day-to-day transactions in a chronological order, that is, the order in which they occur. The process of recording journal entries in the journal is called journalizing. For the journalizing, all the accounts are classified into 3 categories, namely personal account, real account, and nominal account.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.